Welcome back to the Deep Dive. It is Friday, February 27th, 2026. And if you are listening to this on your commute, maybe stuck in the Federal Highway crawl.
Hiding at your desk?
Yeah, exactly. Sneaking a listen at your desk while pretending to look at a spreadsheet. I need you to just pause for a second and pay very close attention.
Because we are doing something a little different today.
Right. This is a special rapid response emergency edition of the show.
Because something massive just happened at 10 a.m. this morning. The floodgates have officially opened.
They really have. The application window is live for what is, without a doubt, the most anticipated Malaysian IPO we have seen in nearly a decade.
It has been 9 years. 9 whole years since we've seen a listing of this magnitude.
Yeah.
And this level of public interest on Bursa Malaysia. We are talking, of course, about Sunway Healthcare Holdings Berhad.
And look, this isn't just another tech startup trying to, cash in on an AI trend.
Right, no.
And it's not some small manufacturing plant hitting the ACE market hoping for a quick flip. This is a true behemoth. We are talking about the healthcare arm of the Sunway conglomerate.
Backed by none other than GIC.
Singapore's sovereign wealth fund, exactly. So the prospectus dropped, the applications are open, and the clock is already ticking.
And the hype machine is in full swing.
Oh, absolutely.
You're going to see this on every financial news portal. Your family WhatsApp groups are going to be buzzing about it.
Your Remizier is probably already calling you.
Probably. But our job here is to, pump the brakes a little bit. We need to look past the headlines.
Right. And before we even get into the numbers, and trust me, the numbers are absolutely fascinating today, I need to ask everyone listening, please hit that like button and subscribe to our YouTube channel right now.
It really helps.
It does. It helps us turn around these rapid response deep dives so you have the info before the application window closes. Because you really don't have much time on this one.
You really don't. But I want to set the tone early here. Yes, the brand is massive. We all know Sunway.
Sure.
We shop in their malls. We play in their theme parks. Some of us went to their university.
Yeah.
But buying a ticket to Sunway Lagoon is very different from buying a share of their hospital business.
Very different.
As we always say on this show, bigger isn't always better.
Yeah.
Especially when we start looking at the price tag.
That is the multi-billion ringgit question, isn't it?
Yeah.
Like, is this a premium price for a premium product, or are we just paying a Sunway tax for the brand name?
That is exactly what we are going to unpack today. We have gone through the absolute mountain of documents released this morning.
So many documents.
Prospectus parts 1, 2, and 3, the detailed application procedures, the accountant's report, the independent market research.
We read it all so you don't have to.
Exactly. We are going to strip away the glossy marketing photos of, smiling doctors and clean hospital beds and look at the cold, hard cash flow.
So our mission today is simple. Should you, the retail investor, be putting your hard-earned money into Sunway Healthcare? Let's dive straight into the first part. The snapshot overview. What are the basics we need to know right now?
All right, let's look at the structure. As of today, February 27, 2026, the retail offering is live. The IPO price is set at RM1.45 per share.
RM1.45. It sounds affordable, doesn't it?
It does.
It feels accessible. It's the price of a very cheap Tetarg. Or maybe half a Tetarg with inflation these days.
Yeah, but that is a psychological anchor, and you have to be really careful with it.
How so?
A stock can be RM1.45 and be incredibly expensive. Or it could be RM100 and be cheap. It all depends on how much profit is behind that single share.
Right.
But strictly on the logistics, applications opened at 10 a.m. today. They close next Thursday, March 5th, 2026, at 5 p.m.
That is a surprisingly tight window.
It is.
Usually these things feel like they drag on for a few weeks. Why the rush?
High demand, likely. They don't need to keep the window open for a month to find buyers.
Makes sense.
The institutional book building is happening concurrently, but for you and me, the retail folks, March 5th is the hard deadline. If you miss that 5 p.m. cutoff, you miss the boat entirely.
And when do we expect to see it actually trading on Bursa Malaysia?
The tentative listing date is March 18th, 2026.
Fine.
They are aiming for the main market, obviously. Now, let's talk scale. At RM1.45 per share, based on the enlarged share capital of roughly 11.5 billion shares.
That's a lot of shares.
It is. The market capitalization upon listing is going to be approximately RM 16.7 billion.
Wow. $16.7 billion. That puts it right up there with the giants.
It does. It immediately becomes one of the largest healthcare stocks in the region.
Yeah.
To give you some context, that is massive for a Malaysian listing. It's why everyone is calling this the deal of the decade. It's a whale entering the pool.
Now, let's talk about the shares being offered, because there are about 1.97 billion shares on the table. But, and this is a crucial distinction for investors that I feel like a lot of people just gloss over, that is split into two buckets.
Yes, very important.
You have the public issue and the offer for sale. Can you explain why that actually matters?
This is vital due diligence. You have the public issue, which involves roughly 575 million new shares.
Okay, new shares.
And then you have the offer for sale, which is about 1.39 billion existing shares.
Right, break that down for us. Why does that distinction matter to the person listening right now?
Because it tells you where your money is actually going. The public issue creates brand new shares. The money raised from selling those shares, which is about RM833.8 million, goes directly into the company's bank account.
Right.
This is the growth capital. This is the money they use to buy bricks, mortar, and MRI machines.
And the offer for sale, a bigger bucket.
The money from that, which is significantly more considering it's 1.39 billion shares, goes to the selling shareholders.
Oh.
It goes to the existing owners cashing out a portion of their stake. It doesn't go to building hospitals. It goes into the pockets of the early investors or the parent company.
So, to put it bluntly, when I buy a share, I am partly funding the company's future, but I'm mostly helping the old owners take some chips off the table.
Correct. And look, it's not inherently bad. Early investors deserve a payday.
Sure, they took the initial risks.
Exactly. And Sunway Berhad needs to unlock value for its shareholders. But as an investor, you generally prefer to see a higher percentage of public issue.
Because that money works for you in the future.
Precisely. In this case, the company itself is receiving RM 833.8 million out of a total deal size that is much, much larger.
Right. So let's focus on that RM 833.8 million that's actually going into the company.
Right.
What are they planning to do with it? Are they just going to, throw a big party?
No parties, unfortunately. It's a very aggressive expansion plan.
Okay.
According to the use of proceeds section in the prospectus, the lion's share, 66.5%, or about RM 554 million, is earmarked strictly for capital expenditure on expansion.
Building things.
Right. They are expanding the existing hospitals: Sunway City KL, Velocity Penang, Damansara, and Kipo.
So they aren't just sitting on the cash, they're building. That's good.
It is. They are specifically using it for renovation, fit-out works, and buying medical equipment.
Like what?
Well, for example, they are acquiring the lower 12 floors of Tower A at Sunway Medical Center Velocity.
That takes money.
A lot of money. They are fitting out the new towers at Sunway City KL. These are tangible assets.
What about the rest of the money?
Then you have about 29.9%, or roughly RM 250 million, going to debt repayment, specifically redeeming the Sukuk Wakala.
Is that a red flag? Paying off debt with IPO money. Some people might say, why do I want to pay off your credit card?
In this climate, it's actually really good housekeeping.
How so?
Redeeming the Sukuk reduces their interest expense, or profit rate expense, since it's Islamic finance. It cleans up the balance sheet and saves them finance costs moving forward.
Which goes straight to the bottom line.
Exactly. It should immediately help the bottom line. It's a prudent move. And the remaining 3.6% is just to pay the investment bankers, the lawyers, the valuers, the fees to make the IPO happen.
Standard stuff. Now, I want to jump to the valuation because you dropped a hint earlier that RM1.45 might not be as cheap as it looks.
It's not. This is where we need to put our analytical hats on. This is where the rubber really meets the road.
Let's do it.
If we take their financial year 2024 net profit, which was RM 257.5 million, and we apply that to the market cap of RM 16.7 billion, we are looking at a price to earnings ratio, or PE ratio, of roughly 64.8 times.
Oh. 64.8 times.
Yes.
Let's pause there for a second. Contextualize that for me. I know tech stocks sometimes trade at 100x, but this is a hospital. What is a normal PE for a hospital stock in Malaysia?
Well, if you look at their biggest peers on Bursa Malaysia, IHH Healthcare usually trades around 30 times earnings.
Right there.
KPJ Healthcare is usually around 37 times. Even looking regionally, healthcare stocks rarely trade above 40x unless they are in absolute hypergrowth mode.
So 64.8 is...
Sunway Healthcare is asking you to pay practically double the premium of IHH.
That is bold. They're essentially saying we are twice as good as IHH, or at least you're going to grow twice as fast.
Exactly. And that is the crux of the investment thesis we need to explore today. Are they actually growing fast enough to justify that premium? Or are they trading on the Sunway brand name and the hype of the IPO?
Before we get to the growth, which I know is the main selling point, let's look at who is holding the bag with us. Who are the major shareholders post-listing?
Post-IPO, the Sunway parent company, Sunway Berhad, through its subsidiary SunCity, will still hold a massive chunk, about 69.5%.
So Tan Sri Jeffrey Che is still very much calling the shots.
Absolutely. This is a Sunway company through and through. They aren't selling out and leaving. They are retaining control.
And GIC. I remember reading a few years ago that GIC put a lot of money into this.
Yes. Greenwood Capital, which is the vehicle for GIC Ventures, will hold about 7.5% post-IPO.
So they are staying in too.
They are. They aren't dumping their shares immediately. And you have a roster of cornerstone investors that reads like a who's who of Malaysian finance, EPF, Tabung Haji, JP Morgan Asset Management.
Okay, so the big boys are in, despite the high valuation. That signals some confidence, right? Institutional investors usually do deeper due diligence than we can. They have whole teams of analysts crunching these numbers.
That's the argument. They are betting that the long-term value creation will outweigh the short-term sticker shock. They are looking at 2030, not 2026.
Let's move on to the business model then, because Sunway does healthcare a little differently than everyone else, don't they? It's not just build a hospital and hope people get sick.
They do. They have what they call the Township Strategy.
Right.
If you look at KPJ or IHH, they often acquire standalone hospitals in various neighborhoods or build them where there is a gap in the market. Sunway's model is to build a massive township first.
The ecosystem approach.
Exactly. They build the Sunway Pyramid Mall, the Sunway University, the Sunway Lagoon theme park, the hotels, the residences, and then they drop a massive hospital right in the center of it.
It's basically like playing SimCity. You place all your high-density residential zones, your commercial zones, and then you just plop the hospital right in the middle to max out your efficiency.
It is exactly that. And the prospectus lists this as a primary competitive advantage. They call it preferential access to sites in Sunway townships.
That's a huge advantage.
It creates an immediate ecosystem. The patients aren't just coming from anywhere. They are the residents living in the condos, the students at the university, the tourists staying at the hotel next door. It's a captive audience.
And it creates convenience. If I live in Sunway City, why would I drive to Subang Jaya Medical Center or somewhere else? I just go to the one 5 minutes away.
Exactly. And it works the other way, too. If someone travels to Sunway Medical Center for a surgery, say from Indonesia, their family stays at the Sunway Hotel, they eat at Sunway Pyramid.
The hospital feeds the township, and the township feeds the hospital.
It's a symbiotic relationship that is very hard for competitors to replicate. You can build a hospital, but you can't easily build a mature 800-acre township around it.
I know for a fact that parking at Sunway Medical Center is always a nightmare,
Yeah.
which is usually a good sign for a business, if not for the driver. Let's talk about the portfolio. It's not just one hospital.
No, but there is a clear mothership. The flagship is Sunway Medical Center in Sunway City, KL. The prospectus calls it a quaternary hospital.
Quaternary. I thought tertiary was the top. What does quaternary actually mean in plain English?
Quaternary is the level above tertiary. Tertiary handles standard complex care, surgeries, specialist treatments.
Okay.
Quaternary means they handle the most complex, high-stakes, experimental, or highly specialized cases. We're talking organ transplants, advanced cancer treatments, robotic surgeries, complex neurology.
Wow.
It's where the toughest cases go. It's the largest private hospital in Malaysia, with 848 licensed beds as of the latest count.
That is massive.
It is, and it acts as the hub. Then you have the spokes, the tertiary hospitals. You have Sunway Velocity in Cheras, Sunway Penang in Sabang Jaya, and then the new entries. Sunway Damansara, which just opened in December 2024, and Sunway IPO, which opened in April 2025.
So the idea is if you walk into Sunway Velocity with something incredibly rare and complex that they can't handle, they stabilize you and ship you to the flagship in Sunway City.
Precisely. It keeps the high-revenue, complex procedures within the group. It optimizes their talent and their equipment. They don't need a robotic surgery suite in every single small hospital. They just need it at the hub. It's capital efficiency.
And they are covering the full life cycle, too. I saw mentions in the prospectus of everything from fertility to senior living.
Yes, they are trying to capture the consumer from literally conception to end of life care.
Cradle to grave.
Exactly. They have the Sunway Fertility Centers, which is a huge growth market as
Right.
people have kids later in life. They have Sunway TCM for traditional Chinese medicine.
Which is smart in this region.
It's a great way to capture the market that prefers holistic treatments alongside Western medicine. And then there is Sunway Sanctuary.
Sunway Sanctuary, that's the senior living facility.
Yes, it is connected directly to the Flagship hospital. It targets the silver economy. It's basically a luxury residence for active seniors, but with medical care right there.
That sounds incredible.
If you have a heart attack, you are literally attached to the best hospital in the country.
That is a very compelling sell for wealthy retirees. Live in a hotel, but be safe.
Exactly. And don't forget the medical tourism angle. Because they have the hotels right next door, they can offer packages. Come for a health screening, stay at the Sunway Resort.
With the Visit Malaysia 2026 initiative kicking off, they are perfectly positioned to capture that foreign dollar.
They are. The weak ringgit makes Malaysia a bargain for medical tourists from Singapore, Indonesia, or even the UK.
It's a compelling story. The ecosystem makes total sense. But let's look at the scoreboard, the financial deep dive.
Yeah.
Are they actually making money? Or is this all just expensive real estate?
They are making a lot of revenue. The top-line growth is honestly impressive.
Let's hear it.
If we look at the trend from financial year 2022 to 2024, revenue grew from RM1.06 billion to RM1.85 billion. That is a compound annual growth rate, or CAGR, of 31.9%.
That is screaming growth. That is way faster than the industry average.
It is. Most mature hospital groups grow at GDP plus a few percent. 32% is tech stock levels of growth.
Wow.
EBITDA, earnings before interest, tax, depreciation, and amortization, is also up, from RM 343 million to roughly RM 470 million. So the core business operations are generating serious cash.
But I hear a but coming. You are shifting in your seat.
But the net profit, the PATMI, profit after tax and minority interest, is growing much slower.
How much slower?
The CAGR for profit is only 10.8%. Revenue tripled the pace of profit growth. And if you look at the most recent data in the prospectus, the 9-month period ending September 30, 2025, there is a glaring red flag.
What is it?
Revenue was up nearly 18%, but net profit dropped by 21.9%.
Oh, wait. Revenue up 18%, profit down 22%. That's a nasty divergence.
It is.
If I ran a lemonade stand and sold 20% more lemonade but made 20% less money, my mom would be asking some serious questions. What happened?
2 words for you: gestation period.
Gestation period, okay.
This is the most critical concept for anyone investing in this IPO to understand. They opened Sunway Damansara in December 2024 and Sunway IPO in April 2025.
Right, so these are brand new hospitals.
Right. And a new hospital is a cash incinerator in its first year.
Why?
Think about it. You have built the building. That costs hundreds of millions. You've hired the nurses, the cleaners, the pharmacists, the admins. You bought the x-ray machines.
All the fixed costs.
Exactly.
Right.
All that depreciation and staff costs hits your books immediately. But the patients, they don't show up on day one. They trickle in slowly as word of mouth spreads.
So you have 100% of the costs and maybe 10% of the revenue.
Exactly. The prospectus notes that Damansara only hit EBITDA positive, meaning it covered its operating costs, not even its capital costs, in August 2025. IPO is likely still in the red or barely breaking even on an operating basis. So these 2 new hospitals are dragging down the massive profits of the mature hospitals, like Sunway City and Velocity.
It's like having 2 teenagers in the house who eat all the food, use all the electricity, but don't have jobs yet. They drag down the household savings.
That is a perfect analogy. The Flagship hospital is the parents working hard, bringing in the money. Velocity and Penang are the older siblings who have jobs, but Damansara and Impo are the hungry teenagers.
Right.
The question for investors is, how long until those teenagers get jobs? Because until they do, that profit margin is going to look squeezed.
And yet, looking at the balance sheet, they aren't drowning in debt, are they?
No, the balance sheet is surprisingly pristine. Net gearing is less than 0.1 times as of September 2025.
Less than 0.1. That's basically no debt.
It's very low. They have strong operating cash flows. They can afford to feed the teenagers.
Okay, that's reassuring.
It's not a solvency issue. They aren't going to go bankrupt. It's just that the accounting profit looks ugly for a bit because of the depreciation and startup costs. Investors need to understand that expansion equals temporary margin compression. You take 1 step back to take 2 steps forward.
Which brings us back to the valuation. We established that the PE is nearly 65 times, and we just established that profits essentially dropped in the most recent reporting period due to gestation.
Correct.
So, expert opinion time. How on earth do they justify asking RM 1.45? If I went to a car dealer and they tried to sell me a car for double the market price because it might go faster next year, I'd laugh in their face.
They are selling you on 3 things: scarcity, growth, and validation.
Break those down for me.
First, scarcity. There are very few large pure-play hospital stocks in Malaysia.
True.
If you want exposure to Malaysian healthcare, you basically have IHH, KPJ, and now Sunway. That's it. Funds, especially EPF, PNB, KWAP, need to hold healthcare stocks because they are defensive.
People get sick whether the economy is good or bad.
Exactly. There aren't many seats at the table, so the few seats available command a premium price. It's simple supply and demand.
Okay, limited supply of hospital stocks, high demand from funds. What's the second one?
Second, growth. As we noted, the revenue is growing at 30% plus. IHH and KPJ are mature giants. They're growing at single digits or low double digits. Sunway is the growth stock of the sector.
I see.
The market is willing to pay a higher multiple today for earnings that will hopefully be much higher tomorrow. It's the Tesla argument versus the Ford argument.
And validation.
The GIC factor. GIC invested way before the IPO, back in 2021. They put in big money.
And they are notoriously careful.
Exactly. GIC is not a gambler. They are a conservative, sovereign wealth fund. They did deep due diligence. The fact that they are holding a large stake signals that they see long-term value that goes beyond the current PE ratio. They are validating the business model.
But is it priced for perfection?
Absolutely, 100%. At 64 times earnings, the market is assuming that Damansar and Equitable will turn profitable very quickly. It assumes the new expansions will fill up immediately. It assumes no major regulatory hits. If they miss an earnings target by even a little bit, the stock could get punished because the expectations are sky high. When you are priced for perfection, you have to execute perfectly.
Okay, so if we are paying for growth, we better be sure the growth is actually coming. Let's look at the growth catalysts. Where is the new capacity coming from? Are they just adding a few beds here and there?
It's an explosion of beds. Currently, they have about 1,982 operating beds. Their target is to hit over 3,400 beds by 2032.
That's a massive jump.
That is a 70% increase in capacity in roughly 6 years. That is not incremental growth, that is transformational growth.
Where are they putting all these beds?
A huge chunk is coming from Tower F at the flagship Sunway City KL Hospital. This is going to be a dedicated children's tower with 216 beds, coming online in late 2026.
A dedicated tower just for kids. Is there that much demand for pediatric care?
Yes, pediatrics is a high-demand, high-emotion specialty. Parents will pay anything for their kids, and if you capture the child, you capture the parents.
That's a very smart strategic move.
It deepens their moat at the flagship. It makes them the go-to place for complex pediatric issues.
And what about new locations? Or are they just building up?
They are spreading out. They have new greenfield locations in the pipeline. Sunway Medical Center Seremban is targeted for 2030. Sunway Medical Center Iskandar Pateri in Johor is targeted for 2030 or 2032.
Iskandar's interesting. That's right near the Singapore border.
Exactly. Think about the geography. With the RTS link being built, the train that connects Johor to Singapore, and the special economic zone discussions, a hospital in Iskandar allows them to tap directly into the Singaporean market.
That's incredibly smart. Healthcare costs in Singapore are astronomical right now.
They are. A simple procedure can cost a fortune in Singapore. Sunway can offer high-quality care at a fraction of the price, just a short train ride away. That is a huge potential market. They are effectively exporting healthcare services without the patient having to fly.
And they're also expanding to Putrajaya.
Yes, Sunway Medical Center Putrajaya is in the pipeline. And they are expanding regionally too. Kota Baru is getting a fertility center. They are widening the net to capture patients who might not want to travel all the way to KL for initial treatments.
And the macro tailwinds seem to support this. We are getting older, sadly.
We are. The aging population thesis is undefeated. Malaysia is becoming an aged nation. Older people need more health care. It's demographic destiny. Plus, insurance penetration is high.
Right.
More people have medical cards, which means they go to private hospitals instead of waiting at government clinics.
So the demand is there, the supply is being built.
Yeah.
But what could go wrong? Let's get into the key risks. We already talked about the gestation risk of the new hospitals dragging down profits.
I want to double down on the gestation risk because the prospectus highlights a cycle here. They are opening Seremban, Iskandar, and Putrajaya in the next few years.
Yeah.
Just as Damansar and Ipoh become profitable, the new ones, Seremban and Iskandar, will open and start losing money.
Oh, I see.
They might be in a cycle of perpetual gestation where there is always a new hospital dragging down the group's margin.
So we might see high revenue growth, but flat profits for a long time.
It is a distinct possibility. Investors need to be patient. You might not see a clean profit year for a while.
What about the doctors? You can't run a hospital without them.
This is the talent war. You can build a shiny building with a marble lobby, but if you don't have a specialist to perform the surgery, it's just a hotel.
True.
The prospectus notes that they rely on consultant specialists. These doctors are mostly independent contractors, not employees.
So they are free agents, like footballers.
Yes. If a competitor opens up down the street, say Columbia Asia or KPJ, and offers a better revenue split or better facilities, the doctor can leave. And in healthcare, patients are loyal to the doctor, not the building.
If the doctor leaves, the patients follow.
Sunway has to constantly work to retain these stars, which can get expensive.
That is a huge vulnerability. What about the government? Any regulatory risks?
Regulatory risk is always there. The Private Healthcare Facilities and Services Act, or PHFSA, controls everything. If the Ministry of Health decides to freeze new bed licenses, Sunway's expansion stops. But the more immediate risk is the insurance pressure.
You mean the co-payment thing?
Yes. In September 2024, Bank Negara Malaysia introduced new rules requiring insurers to offer co-payment options. Basically, patients have to pay a portion of the bill themselves, say 5% or a fixed amount, in exchange for lower premiums.
Which implies that patients will start actually asking questions about the bill.
Exactly. It introduces price sensitivity. If patients have to pay 10% of the bill out of pocket, they might think twice about going to a quaternary premium hospital for a minor ailment.
Right.
They might ask, do I really need this expensive MRI? Or can we use the generic drug? It could compress average bill sizes and reduce patient volume for minor issues. The buffet mentality of healthcare might end.
That is a really subtle but important point. We've been used to insurance paying everything. If that changes, the premium hospitals might feel it first. And finally, concentration risk.
This is the elephant in the room. Even with all these new hospitals, the Flagship in Sunway City, KL, is still the 800-pound gorilla. It contributes a massive percentage of their revenue and profit, historically over 60 to 70%.
So if there is a flood in Sunway City, or a localized outbreak, or just a management issue at that one site,
the whole group takes a massive hit. They are not as diversified as they look on paper yet. Until the other hospitals mature, Sunway City KL is the company.
Okay, we have the snapshot, the model, the financials, the valuation, the catalysts, and the risks. It is time for the verdict. I want you to put on 3 different hats for me. I want the short-term view, the medium-term view, and the long-term view.
All right. Let's start with hat number 1, the short-term trader. You're looking for a listing gain. You want to flip it in the first week.
What's the verdict?
Verdict is a high probability of a pop. Hype. It's the biggest IPO in 9 years. The Sunway brand is gold in Malaysia. The cornerstone investors have locked up a huge chunk of shares, so supply is tight. Retail demand will likely be oversubscribed. I would be surprised if it doesn't open above RM1.45. The sentiment is just too strong. People want a piece of this action.
Okay. Hat number 2, the medium-term investor. Someone looking 1 to 3 years out.
Verdict, caution, hold.
Why the change?
Because the hype will fade and the earnings reports will start coming in. Those reports are going to show the drag from Damansara and IPO.
The hungry teenagers.
Right. Investors might look at the PE of 65x, see flat profit growth because of the gestation costs, and say, this is too expensive. We could see a period of share price stagnation or correction as the earnings catch up to the price. The valuation needs to digest the growth. It might be dead money for a year or 2.
Hat number 3, the long-term compounder. The buy and hold for 10 years investor.
Verdict, buy.
Because of the moat.
Yes. The financial moat score here is an 8.5 out of 10.
That is a high score.
It is. The township integration is a fortress. Competitors can build hospitals, but they cannot easily build a mature township with hotels, universities, and malls around it to feed patients into the system. Sunway has spent 30 years building that ecosystem.
Yeah.
You cannot replicate that overnight. By 2030 or 2032, when all these new hospitals mature and stop bleeding cash, the cash flow generation is going to be massive.
So if you have the patients to ride out the gestation blimps, the destination is worth it.
Exactly. It's a compounding machine, but you have to let it compound.
All right, let's wrap this up with our final conclusion. Who should be clicking submit on that application form right now?
If you believe in the Malaysia healthcare story, that we are getting older and richer, and you are willing to lock this money away for 5+ years, this is for you. Also, if you are looking for a blue-chip defensive stock to anchor your portfolio and don't mind paying a premium for quality, Sunway Healthcare fits the bill. It's a sleep well at night stock, even if it's expensive.
And who should stay away?
Value investors. If you strictly follow Benjamin Graham or Warren Buffett's value principles, stay away. A PE of 64x violates every rule of value investing. You are paying for growth that hasn't happened yet. Also, if you need high dividend yields right now, look elsewhere. The yield will be low because the valuation is so high, and they are reinvesting every spare ringgit into building new towers.
And for those who do buy in, what is the one thing they need to watch in the first few quarterly reports?
Watch the EBITDA margins of the new hospitals. Look specifically at Sunway Damansara and Sunway IPO. Are they narrowing their losses? Are they moving towards profitability? If those losses widen or stick around too long, the stock will suffer. That is the canary in the coal mine.
And watch the progress on Tower F. The Children's Tower is key to the next leg of growth at the Flagship.
Absolutely.
There you have it, the biggest IPO in a decade, stripped down to the nuts and bolts.
It's a premium price, no doubt, but you are buying a premium asset. It's like buying a house in a prime location. You pay more, but it usually holds its value.
Thank you for joining us on this emergency deep dive. Remember, applications close strictly at 5 p.m. on March 5th, 2026. Do your own research, read that prospectus, it's long, but it's worth it, and make the decision that fits your portfolio.
Stay rational out there. Don't let the FOMO drive your decision. Look at the numbers.
If you enjoyed this breakdown, please smash that like button. It really helps the algorithm show this to other investors who might be scrambling for info. And comment below, are you applying for the Sunway Healthcare IPO, or is 64 times earnings just too rich for your blood? Or let us know what IPOs you want covered next. Let us know down there.
We read every single comment.
We really do. Subscribe so you don't miss out, stay curious, and stay informed. We'll catch you on the next deep dive.